As the U.S. markets are currently closed, Nuburu Inc., trading under the ticker BURU, closed the last session at $0.51 per share. This represented a significant intraday gain of $0.037, marking a 7.74% jump. Now, seeing a pop like that in a stock trading under $1 immediately triggers a specific kind of investor expectation. The narrative is almost pre-written. It's a volatile penny stock, probably moving on pure speculation or some whisper of news. A classic high-risk, high-reward gamble you might take a small position on through your Robinhood app or SoFi Invest account. The expectation is that this is a lottery ticket. But the reality of what's happening beneath the surface here is far more complex and tied to the very tangible, gritty world of industrial manufacturing. That 7.74% move wasn't just random noise. It was accompanied by a noticeable uptick in trading volume, suggesting that this wasn't just retail traders chasing a momentum blip. There's a deeper current moving here, one that has to do with the specific physics of light and the global race to build better batteries. Most people looking at Nuburu see a de-SPAC that has been absolutely crushed, falling from its post-merger highs and seemingly destined for obscurity. The common belief is that it's another speculative tech company with a great idea but a broken business model, bleeding cash with no clear path to profitability. And to be fair, the financials are concerning, and the cash burn is a very real threat. That's the story the simple chart tells you when you pull it up on a Fidelity trading platform or through interactive brokers. But that story misses the fundamental point of why this technology even exists. Nuburu's entire thesis is built on the unique properties of blue laser light, particularly its near-perfect absorption by conductive metals like copper and aluminum. This isn't just a slightly better laser, it's a completely different approach to welding and additive manufacturing for materials that are foundational to the electric vehicle and consumer electronics industries. The market's expectation is focused on the company's financial statements, but the reality is that its true value proposition lies in the material science, something that balance sheets don't capture. The real question is whether they can survive long enough to make the industrial world fully appreciate that scientific advantage. Let's break down the recent trading activity because it tells a story of a quiet battle being waged. That 7.74% gain wasn't an isolated event. Over the past month, we've seen several sessions with these sharp, aggressive pops, often followed by a slow bleed down over the subsequent days. This isn't the pattern of a stock simply drifting. It suggests periodic, concentrated buying interest. The volume on that last upward move was nearly double the 30-day average. When you see volume confirming a price move, especially in a microcap stock, it forces you to ask who is buying. Is it a fund specializing in deep tech that sees a mispriced passette? Or perhaps it's an informed party that has an inkling of a forthcoming contract or partnership. We can't know for sure, but it's a deviation from the norm that warrants attention. An individual brokerage account holder might see this as a sign to jump in, but a more seasoned investor using Schwab Intelligent portfolios for their core holdings would likely demand more evidence. The reaction to their last quarterly earnings report was also quite telling. The headline numbers, revenue and earnings per share, were not impressive. The stock initially dipped, which is what you'd expect. However, during the investor call, management spoke at length about the progression of several key customer trials in the EV battery manufacturing sector. They didn't name names, but they detailed the technical milestones being met. The stock actually recovered most of its post-earnings losses within a week of that call. This shows a small but dedicated group of investors are listening past the headlines and trading on the operational details, a sign of a potential disconnect between the market's short-term focus and the company's long-term progress. This isn't happening in a vacuum. The entire additive manufacturing and industrial technology sector has been under immense pressure. Rising interest rates make it harder for these capital-intensive businesses to fund operations and for their customers to finance big equipment purchases. We've seen similar struggles with other de-SPACs in the space. So part of Nuburu's poor stock performance is just being caught in a brutal macroeconomic tide. However, the specific demand for their product is tied to a countercurrent, the relentless government-subsidized push for electrification. Companies building EV batteries need to weld copper foils that are incredibly thin and reflective. Traditional infrared lasers struggle with this, often causing spatter and weak connections, which is a disaster for battery performance and safety. Blue lasers, due to their wavelength, get absorbed beautifully by copper, resulting in cleaner, stronger, faster welds. This is Nuburu's entire game. While the broader market frets about interest rates, Nuburu's potential clients are facing immense pressure to scale up production and improve battery quality. This creates a fascinating tension. The macro environment is hostile, but the specific industrial need for their solution is becoming more acute every single day. The investment help you might get from a standard financial advisor might flag this as too risky, while a specialist in industrial tech might see a compelling, albeit speculative, opportunity. So what does Nuburu actually do? At its core, the company designs and manufactures high-powered blue industrial lasers. Think of it less as a speculative tech firm and more as a specialized tool maker for the 21st century. Their business model is straightforward. Sell these laser systems and associated support services. The target markets are primarily e-mobility, welding battery components, automotive, welding powertrain components, and consumer electronics, welding intricate parts in phones and other devices. Historically, the company emerged from research focused on overcoming the limitations of infrared lasers. They successfully commercialized the world's first area printing capable blue laser, which allows for faster and more efficient 3D printing of metal parts. Their journey to the public markets via a SPAC merger in late 2022 was, like many at the time, met with initial enthusiasm followed by a brutal market correction. Past financial reports have consistently shown a company in the pre-scaling phase. Modest but growing revenues overshadowed by significant research and development costs and operating expenses. This is the classic profile of a company betting everything on its technology gaining widespread commercial adoption before its capital runs out. Their success isn't just about having better tech, it's about navigating the incredibly long and demanding sales cycles of industrial manufacturing, where a new piece of equipment has to be rigorously tested and qualified before a purchase order is ever signed. This process can take years, and that's a tough reality for public market investors who are used to the quarterly performance cycles of companies like Apple stock or Nvidia stock. Looking ahead, the future of Nuburu is a study in divergent possibilities. The expectation, fueled by the promise of its technology, is that a major automotive or battery manufacturer will announce a large-scale deployment of Nuburu systems. Such a validation would be transformative, instantly quieting concerns about cash burn and proving the commercial viability of their product. A partnership with a company on the scale of Tesla would completely rewrite the narrative for Nuburu. That's the bull case. It's the scenario where the company's technical superiority in a critical manufacturing process finally translates into exponential revenue growth. This is the outcome that keeps speculative investors holding on, making small, calculated buys through SoFi investing or other accessible platforms. Another potential catalyst could be a strategic investment from a larger industrial player or even an outright acquisition. one. If a major industrial automation company like Siemens or Rockwell Automation decided that blue laser technology was a critical component for the future of manufacturing, Nuburu would be an obvious target. However, the reality is that the path forward is fraught with risk. The most immediate and significant risk is the company's financial health. Their cash runway is limited, and in the current market environment, raising additional capital is difficult and often highly dilutive to existing shareholders. Every share they issue at these low prices make it harder for the stock to appreciate significantly in the future. There is a real possibility that they could simply run out of resources before their technology hits its commercial inflection point. This is the stark reality that contrasts with the optimistic technological expectation. Furthermore, they are not the only ones working on blue laser technology. While they have a strong intellectual property portfolio, competition could emerge, either from startups or from established laser companies that decide to invest heavily in this area. The risk of being delisted from the exchange if their share price remains this low is another practical concern that can trigger further selling pressure. These are the serious considerations that anyone looking at online investing options needs to weigh. It's not enough to believe in the technology, you have to believe in the company's ability to execute financially and operationally under immense pressure. Comment below what you believe is the biggest hurdle for blue laser technology adoption in the EV industry.